I'm ready to go, huh? Testing 1, 2, 3. Good morning, Sabrina. Don't mess this up. And welcome back, ladies and gentlemen. I apologize. I totally forgot I was doing a podcast today, and I wore this shirt, and I don't want to offend anybody. I mean, it is what it is. Okay. I'm in Louisiana. I love LSU, but I was raised in Oklahoma. My kids played for Oklahoma, so I'm sorry. Next time I'll wear something else, okay? And you may have seen on the news, the broadcast or whatever, I got robbed at a convenience store the other night, took all my money, called the police. The police came and said, "You got any idea who it is?" I said, "Yeah, I know who it is." They said, "Well, who is it?" I said, "It was pump number 4. Okay, moving on. If you will listen to this 10-minute whatever podcast, you're not going to want to because there's so many figures and calculations and and you're not smart enough to keep up with it. But if you will listen to this 10-minute podcast, I'm going to promise you something. I'm going to promise you that you will be the hero to at least one person. I bet 10, 15, you will be a hero to family members, relatives, friends, people by mentioning one or two of these things that I'm getting ready, you will be a hero to them for the rest of their life. You'll see them 20 years later and they say, I never forgot you because you told me this. We didn't even think about it. So this is important. It's one of the things that when I did my radio show for 20 years, people would call and they think, oh my goodness, All right, here we go. Over 50% of all home buyers in the United States, over 50% have put less than 20% down. Okay? Conventional loans, FHA loans, VA, whatever. But over 50% of people listening, if you own a home, have put less than 20% down. That's kind of common, okay? If you put less than 20% down, then you totally forgot when you signed the papers and everything, but the lender told you you paid an extra insurance premium. We call it PMI, private mortgage insurance, on a conventional loan. We call it MIP, mutual insurance premium, on an FHA loan. But the bottom line is you can't get an FHA loan without paying that premium, which is guarantees that loan, okay? Now, you can foreclose, but they're going to get paid. But you're going to pay that on an FHA. And if you put less than 20% down on a conventional, you're going to pay that insurance premium. You're going to pay it. So 50% of the people that own a home in the United States of America have that, and they may vaguely remember they did it. When the lender pre-qualified them, they said, okay, you pay on this interest rate, your principal and interest will be X dollars, but now we have to add this insurance, which I mentioned to you. It'll be and they say, well, okay, total thing is okay. So they do it, and they close it, and it's done. All right, here's the deal. Now, I want to tell you right now, wait for the ending. If you don't want to listen to me or you hate Oklahoma, just fast forward to the ending, okay? Because there's something I'm going to tell you that's going to surprise a lot of people. Now, I say over 50% of people There are a few little, VA loans, you don't pay anything, and that's less than 20% down. There's a few little special loans that don't have, but basically over 50% have that in them. Let's talk about FHA MIP to start with. The FHA MIP, if you get an FHA loan, now it's changed over the years. Right now, and it could vary a little bit or certain situations, but overall, on an FHA loan, you're going to pay two parts of that premium. What I'm getting to is how to get rid of that. That's what I'm telling you, okay? Okay, but on an FHA loan, it's about 1.75% of the loan amount up front included in your loan. If you get a $200,000 loan, 1.75, what, $3,500? $200,000, they're going to add $3,500 up front to your loan and make it $203,500. Okay, that's up front. That's done over with. Yeah. But FHA is also going to add a monthly premium to that. It's the same MIP, same insurance. They're just trying to get some up front and breaking it up. But that monthly premium on an FHA, and it's changed over the years. It's dropped quite a bit. But right now, I'm just going to say 0.55%. Now stay with me. 0.55% on a $200,000 loan. Sabrina, sorry, I forgot that figure. Forgot to put that figure down. Oh. 0.55 to 1,100. Okay, here we go. I'm just going to use 0.55 annually. Now that 0.55 on a $200,000 loan is what, $1,100 a year? But they're going to break it up monthly, so that makes it what, like $92 a month. So you can figure 0.55 times your loan amount. That's what they want every year, but they're going to do it every month, so divide it by 12. $200,000 loan, it's going to be about $92. Now, some of you could be paying as low as $50, $60, $70. A whole lot of you are paying $200, $300 a month on that, okay? But you're paying that monthly. Now, how do you drop those things? Well, on an FHA loan, if you put less than 10%, if you put less than 10% down, and typically FHAs are 3.5%. People get an FHA loan because it's only 3.5% down. If you put less than 10% down on an FHA loan, then that MIP premium is for life. For life. You can't get rid of it. Well, at the end, I'm going to tell you how to get rid of it. But they're not going to drop that for life. If you put more than 10% down, if you put 11%, 15% or something, now you start putting 15%, 20% down, you need to go to a conventional. But if you put more than 10% down on an FHA loan, then that MIP automatically drops, okay, in 11 years. 11 years. If you put over 10% down on an FHA loan and you've had that 11 years, then it should automatically have dropped. Check on that, okay? Now, in 2013, if you took an FHA loan out prior to 2013, now that's like 13 years ago, okay? But those premiums were a whole lot higher. On this same scenario, at $92 a month, that would have been about $225 a month. But in 2013, if you did it, then it should automatically drop at a certain time. But I'm not sure how many of you have done that. All right, I'm taking a break to change my sheet here. All right, let's move on to a conventional loan. Now, here's some interesting stuff. If you got a conventional mortgage, Now, if you put 20% down or more, then you have no PMI, private mortgage insurance. 20% down. People say, well, I'm put 10, 15% down. Sometimes I've said, hey, go borrow the money from your family or from a bank or something. There's ways you can do that and get out of that $200-300 a month PMI thing, okay? On PMI, unlike FHA, typically a lender doesn't charge up front. There's an option, but typically they do not charge an upfront thing and add it to your loan. They charge the monthly thing. That monthly thing can be 0.5 to 1.5% of your loan amount that they want every year. Let's just take 1%, okay? You may not see it, maybe less or more. Let's just take 1%. That $200,000 loan on a conventional loan, when you put less than 20% down, if you put 5%, 10%, 15% down, which happens a lot, then let's just say 1% on a $200,000 loan, that's $2,000 a year they want every year. Now, that $200,000 divided by for the year, I did it again. I'm just testing you, Sabrina. She didn't type this right. Okay, let's see what she did. That 1% on a $200,000 loan is $2,000 a year that they want, but they're going to divide that by 12 to get it every month, and that's like $167 every month that they have added to your mortgage payment on a conventional loan less than 20% down. Okay? Now, how do you get rid of that? The law says once your conventional loan drops, when the principal balance drops to a 78% loan to value, 78% loan to value on the original loan amount, then they have to automatically drop that. They have to automatically drop that. If you've had a conventional loan 10, 11, 12 years, then in 13 years, or once it drops to 78% loan to value from the original loan amount, they have to automatically drop that. Now, on average, that takes like 13 years to go from the loan down to a 78% loan, basically to pay 22% of your principal down. That's about 13 years of doing that. But, you ready for the but? It's always a but. Once you can show that the current value, that your loan amount, your current principal balance on your loan is 80% of the current value of your home based on a new appraisal, they can drop it. Now, you can call them and say, will you drop it because my value, and if it's been several years, they may say, well, yeah, your property has problem. Or, I believe you can get an appraisal, send it in, and say, here's my current value. Here's the kicker, ladies and gentlemen. Those hundreds of thousands of you that have a conventional loan with less than 20% down, the average appreciation of a home in the United States over the past 10 years, you can Google it, I think it's been about 7%. Now, when we average, you like to use 4 or 5%. But the reality is the average appreciation of a home the last 10 years in the United States has been right at 7%. 7% on your $200,000 loan that we're using as an example. 7% a year in 3 years, 3 times 7 is 21% that your home has gone up in value. So now your home in 3 years is probably at an 80% loan to value, and that's not even considering the principal reduction. You add the principal reduction, which is not a lot over 3 years. I I'm thinking a lot of cases, 2.5 years, you can get a new appraisal. Why is this? Oh, this says stop recording. I don't know why it did that, but I'm going to keep going. But I'm thinking there's a lot of cases in 2.5 to 3 years, you get a new appraisal, you send it to your lender, you're at 80% loan to value, you can drop that PMI. You can drop that, what, $167 a month? $2,000 a year? You're saving $2,000 a year by dropping that? I'm going to say half of you people, or half of the people that have conventional loans, if you mention PMI, they, oh yeah, I remember, I think, didn't they say it was something insurance or something or another? You don't even know how much it is. Pull your settlement statement and look at it, okay? So you can drop that. Now, are you ready for the now? I said, wait. Here's the other thing. Refinancing? Yes, you can refinance, be it a conventional loan with PMI or an FHA loan with MIP. You can refinance at any time if you can do an 80% loan to value, refinance to a conventional, and drop that PMI. Now, if you have a 10% down conventional loan or an FHA loan, well, 3 or 4 years, yeah, you're at, in my opinion, from the appreciation, you're at the 80%. So you can refinance. Now, here is the interesting thing. You're going to say, I did this loan at 5%, and current rates are 6%, and 1% is not enough difference to refinance. Everybody has told you on refinancing, well, if you go from 6.5 to 6, or you drop a quarter or a half or 3/4, you're not thinking about this, and they're not thinking about this. I'm going to say, on average, could be less or more, dropping that MIP or that PMI is going to be about the difference of 1% in the interest rate. Okay? That's hard to believe. Now, sometimes it could be 1.5 to 2% difference in the rate. If you have a year or so ago, if you did it at 7% and rates are, let's just say 6.5 now, you're going to say, well, that's not worth refinancing. Well, if you could refinance and you have the appreciation, principal reduction, to go 80%, then you're not only dropping that 0.5%, you're dropping 1.5% equivalent. You got to think about that. Hey, call me sometime. My phone number's somewhere. I don't know. She'll post it on the thing. I don't want any money. Call me. We'll figure it out. Call your lender. But you're not going to remember all these numbers, all these figures. Just know, number one, do you have MIP or PMI on your loan? Check that. Check that. Then confirm with your lender. Google it. How can I drop MIP? How can I drop conventional? Or just listen to my video again, okay? Now, I always do an extra. Click on this extra. You'll laugh for a minute, okay? God bless you. Pray for my sinners.